Hello, my name is LeJeune, and today I'll be discussing my financial analysis on 10 stocks. I chose 5 stocks in analytical lab equipment, and I also chose 5 stocks in casual restaurants. In analytical lab equipment, I chose Astron Bioscience, Thermo Fisher, Mettler Toledo, Waters Corp, and Bruker Corp. And casual restaurants, I chose Buffalo Wild Wings, Cheesecake Factory, BJ's Restaurant, Darden's Restaurant, and Del Frisco's. Alright, first, when choosing a company to invest in, we want to first look at the EPS of the company, and trailing 12 months is a way to compare these companies in the same timeline. I also trailed these companies over the last 5 years. I chose to invest in Mettler Toledo, that's the highlighted section here, since they have the highest EPS, with it being 5 times more than the industry average. In addition, we look at the price-earnings ratio to see if we are overpaying for our stock. The average PE ratio for the S&P 500 ranged from 20 to 25. So based on that, I can configure if my stock is over or undervalued. All 5 of the companies we look at have a PE ratio less than the industry average. However, Mettler Toledo and Waters Corporation have PE ratios ranging from 20 to 25, which is an ideal range. So naturally I choose Mettler Corporation stock since it has a better earnings per share than Waters Corporation. Moreover, we're going to look at the return on equity. Mettler is a superior choice compared to the other 4 with 34.74% return on equity, shown here in the highlighted section, compared to the industry average of only 10.49%. When breaking ROE down, I found that this company had a healthy operating margin and great asset efficiency, which could be driving its ROE up. Next, we're going to look at ROA. It's the next one over. And this gives us an idea of how efficient the company is at using its assets to generate earnings. Again, we see that Mettler has the highest ROA within the industry. Astron Bioscience is not far behind. It is far behind. After being merged with Versio Corporation, it has a negative ROA, shown here, and this is because the firm is changing its capital structure. We look a little deeper into the asset structure of the company with total term debt. This gives us an idea of how much the company is borrowing to generate income. We want to see how much total debt is compared to total enterprise value to see how a company manages their debts. Mettler comes in at 5.58%, which is much lower than its competitors, with the average at 11.46%. Moving on, next we want to see how much a company is paying to fund their operation and expansions. We look at the weighted average cost of capital, where each category of capital is proportionately weighted. That is shown right here to the left of ROE. The WACC of a firm increases as the beta and rate of return on equity increases, as an increase in WACC notes a decrease in valuation and higher risk, of course. We want this rate to be as low as possible. So Mettler has a slightly higher rate of weighted average cost of capital than the industry average. Water Corporation and Thermo Fisher have a lower WACC, but with all things to consider, NTD is still the primary choice because of the other variables that I addressed earlier. Now we're going to look a little bit at economic value added. That's shown over here, set aside at the end. And this is basically an estimate of a firm's economic profit. Quite simply, EVA is the profit earned by the firm less the cost of financing the firm's capital. The idea is that value is created when the return on the firm's economic capital employed is greater than the cost of that capital. We want a positive economic value added. For the 5 companies that we have, only Mettler and Water Corp have positive economic value added, while the industry average is at a negative 60 million, further backing my stance on choosing Mettler Corporation as the primary stock in this industry, or my choice. Similar to the analytical lab equipment industry, we're going to look at the mentioned ratios for casual restaurants. Okay, restaurants are more volume based. That's why the companies in the lab equipment sector have higher profit margins. For the EPS, all companies have a positive EPS, from what I can see. Buffalo Wild Wings and Del Frisco's restaurant have a little bit better EPS than the industry average of 3.1, shown down here at the bottom. Now, relative to PE ratio, Cheesecake Factory has the best PE ratio, the lowest, compared to the industry average of only 30.73. Buffalo Wild Wings, BJ's Restaurant, and Darden's Restaurant all have PE ratios below the industry average, or actually, sorry, slightly above the industry average. All five companies have a lower ROE than the industry average, with Cheesecake coming in at the highest of the five at 19.77%, while BJ's Restaurant and Del Frisco's have very low ROE at 5.44 and 6.52% respectively, shown here. However, when considering the DuPont analysis and breaking down ROE, it clearly shows that Cheesecake ROE is higher than competitors because all of its variables are outperforming the industry. Like operating margin, asset efficiency, debt leverage, tax, interest. We proceed to look at, so now we're going to continue to proceed and look at the return on assets for these companies. And once again, we see that Cheesecake, alongside Buffalo Wild Wings, have the highest ROA of the group, beating the industry average of 7.65%. These five companies have limited debt compared to enterprise value, which is a good measure. Darden's Restaurant has 18.47% of debt to enterprise value ratio, which is 4% higher than the industry average, which is good. And the rest of the group has minimal debt to economic value ratio, ranging from anywhere between 0 to 2.5%, which is not a very big spread. On the other hand, Darden's Restaurant's WACC was below the industry average. In addition, the economic value added for these companies are very minimal compared to the industry average, with 3 of the 5 with negative economic value added. Overall, with these ratios in mind, I choose Cheesecake, higher EPS, higher price per earnings, a minimum WACC. And between Mettler, my first choice in the analytical lab equipment, and Cheesecake Factory, I'm going to choose Mettler. Simply out of industry preference. I guess you can say I've fallen victim to the industry effect, so to speak. And also, Mettler has more promising ratios to offer. Thank you.